Go for it.
Hello there, welcome to the first edition of the weekly video Capital Spreads of 2014. Bill's still here with us to tell us what he thinks of the markets and hopefully shed some light on what has happened, what's going to happen so far. So Bill, let's start with last night FOMC didn't tell us anything we didn't know. BOE doesn't change rates, nor does ECB. When might something happen that...
I think we almost have, of course we have three central banks, but we have three, I think, differing stories. But I think what we saw last night from the Federal Reserve was a justification for the market being confused.com from May till almost December of last year, expecting, tapering was going to start ASAP. Again, they reiterated last night that, quote, it's data dependent, we knew. Also, the simple fact is that tapering is not tightening. And I think one of the things that the bond market, and I hate to say this, I haven't been a bond man, the bond market had been telling us for months now, where everybody said, well, once they stop tapering, 3.25%, 3.5%, when are we going to see 4% for the 10-year? Well, we're still struggling to get even close to 3%. Again, it all may change tomorrow at 1:30 GMT when we get non-farm payrolls, because I think my early call was plus 190,000 and no change in the rate. Now, after the ADP numbers, I know that on the Bloomberg survey, a number of people have increased it by like 30 to 40,000. But I think one of the things that, I don't think people are getting too overly excited about is, because of the polar vortex that we're all seeing in the States.
But that's not going to affect December's number, is it?
No, not at all.
So
but the simple fact is, you could have, and remember, jobless claims are not annualized. Jobless claims, or if you can't get to your claims office, whatever day it is, then it says that Joe Bloggs, Fred Smith didn't show up. Okay, so there's nobody. So therefore, we could have 1, possibly 2 weeks of distorted numbers for the January. Now, I'm not saying that's going to be yes or no, but there are already people talking about you can take 0.2% off of GDP growth in the first quarter. But
because of a bit of cold weather.
Yes, I've got friends of mine in New York who are having a wonderful time. They haven't gone back to work yet this year. Okay, and it's no different whether it's in New York or Chicago. And yesterday, I think for the first time in history, all 50 states, including Hawaii, which is quite tropical, had at least one place in Hawaii which was below freezing, which had never happened before.
Right, gosh. So, moving on to the Eurozone.
Yes.
Well,
let's go back to the B of A. There were some people out here today, about 15–20%, feeling we could get a statement from the Bank of England, about what are they going to do about quantitative easing, because we do have rather a dichotomy here. I think the FT was talking about, the Bank of England better be ready to raise rates immediately, okay? We've also had Mark Carney basically saying, calm down, don't get so excited about it. Yes, we're seeing maybe a slight bubble in the housing market, but, let's look at the real numbers. All you got to look at Tesco's, Selfridge, Debenhams, Mothercare. They had an horrific Christmas season. So retail is not going out, with...
And then today, Marks and Spencer's and Morrison's. And,
yes.
Yeah.
And this is, we're talking about food, So you can cut back on stuff, but you still have to eat. So I think the recovery is still recovering. And I think what we're going to need from, Dr. Carney sooner rather than later is a reiteration of what he said in July. Interest rates really aren't going to be going up till early 2015 rather than the end of this year.
Right. Well, that's the whole point of forward guidance.
Yes, exactly right. Okay.
And there's a whole load of levels in there, which he said.
Well, you just said the key word, okay? And the Fed said it last night, data dependent. I know the market is expecting, will the Fed change, the 7% rate to a 6.5% to a 6%, going towards the Evans rule. I think one of the things where I will be pleased is the simple fact is most of the material that has been written for the Fed, for tapering, was written by the new chairwoman who will start, the 1st of February. So I think we will have a better clarification. She's been around long enough, okay? For the simple fact is, and maybe it's me in the old school where, when we were growing up, we didn't have a road map. It's sort of like, you had to get an old A to Z out rather than, in the next 4 minutes, make sure that you drop interest rates 50 basis points, and then take a left at the next stoplight, okay? I mean, it's getting rather silly whether it's, you know, a sat nav or this, that, and the other. Because, I mean, all I can, and again, I'm sure my age, this goes back 30 odd years ago, where the Bond Market Association in New York always has a major function before Christmas, and there's always a lead speaker. The lead speaker of 30 years ago-ish was Alan Greenspan as chairman of the Fed. And he made the comment, this was long before taking away the punch bowl, was basically said, well, you as the market makers tell us what the rates are. We just react accordingly. And I think the Fed told us that last night. We will react when the market tells us, whether it be the trading market, whether it be data market, okay, where the recovery is on a firm footing.
Understood. Let's say tomorrow the non-farm, there's 300,000 jobs being created.
Yes. Whoa.
You know, that's probably not going to happen, but let's say that's much better than expected. Is that good news for markets or bad news?
It will be good news for the markets, okay? It will be bad news for the bond market. We'll get back to that 3% level.
So how come we're now at that? Why have we suddenly moved from good news being bad news to good news being good news?
Is the glass half filled or is it half empty? That's what makes markets.
Yeah.
And the simple fact is that what we'll have to look at, and one of the things, and I don't know whether we've discussed this before, but looking at the US and especially here in the UK. In the UK, remember, we have almost half the working population, either as temps, pop-ups, or these, you know, no work, no pay type thing. Well, you know, and there are a lot of people who are taking any job, and I mean any job, to make sure that they are in situ when the market starts to, you know, and the boss doesn't say, well, we get rid of Charlie, you know, we're looking for Fred. And the same thing's happening in the States. I mean, there's still a tremendous amount of temporary work because, you know, the key thing, as we saw, the ISM numbers this week, not that great, okay? Also, the durable goods orders, not that great. The one thing that really got it started was the employment component for the ISM, and especially yesterday's ADP numbers, you know, were much better than expected. So the question is now, has the market discounted maybe 225 as the correct number? But I think more people will be, more analysts and more traders will be looking at what is the rate rather than, you know, my feeling was earlier I was plus 190, but no change in the rate at 7%. And I think most people feel now that even the Fed, and especially here in the UK, especially in the UK, where the unemployment rate has fallen, you know, faster than the Titanic went down. You know, now what do we do? They got me in a good fix this time, as Laurel and Hardy used to say.
Okay. The next thing I want to talk about, the UK equities, the FTSE performed worse after they all had their peaks in May,
sure,
relative to, you know, its counterparts, the DAX, the Dow Jones, the S&P. Why was that? And
well, I had to look at the currency, and then all of a sudden, what helped, even with the FTSE, because remember we had a massive IPO, and I mean I think they're talking like 30 billion in IPOs this year, you know, safe strategy, et cetera, et cetera. Also, one of the things that you had to look at was as much bond flows. I mean, I know we talked about, you know, like 3 years ago, you know, the Greek 10-year was like 20%. It's now like 7.25%. That's some heck of a move. You know, we had a 2.5-year low, or an all-time low in the 2-year in Spain. Okay, Italy's a little bit of a problem, and so is France. So what you did see was you probably saw some people going into the bond markets, but also, and I think what we're seeing now is a healthy correction. And I mean, there are people out there, I mean, talking the year end for the FTSE for this year. I mean, there's one person out there that's talking 8,000. Now, no names, but
he doesn't know that.
I mean, someone
no one
concerned.
knows.
Well, I know who it is. But the simple fact is, this is the same person who's predicting 8,000 for the FTSE at the end of this year was talking about parity last year for the euro. So there's like this, that, the other. But I mean, we're still looking at probably, you know, mid 7,000s, and I think that will probably happen because I think we'll see a safe environment here in the UK. We'll see a stable currency. I think it's a situation where 164, 165, 168 is much too high. Let's, you know, get it down to the low 162. 62, something like that.
Yeah, which was part of another question of mine is the strong pound going to hurt us?
Yes, it will. Okay. The one thing that's helping us is the simple fact that with what's happening with reference to the tapering, you see the situation in India, Indonesia, the emerging markets, if you will. I mean, I think the South African rand traded at a 5-year low today. Okay, Turkey economically, but Turkey's being clobbered because of the political situation there. So what you're going to want to have is a solid situation. But one of the things, and let me just, for the first time in history, 2014, okay, there will be more people in the world, over half the world's population will be voting in an election, which has never happened before. This year. So my feeling is politics globally could almost have more of a major impact for the year than it could dictate economic policy. I mean, we talked about India being in real problems right now. They've got an election coming up in March, some of the European nations. But it's quite interesting with the global picture of elections in 2014.
It's a good statistic there.
Yeah.
Okay, let's find out where you think we'll be this time of the year. You've said that at the end of the year, FTSE will be 7,500 points. What about for everything else?
I think we'll have a record in the DAX. I think we're continuing, okay, the U.S. markets, okay. There'll be a record, S&P, the Dow, the NASDAQ. One of the things that I think we'll probably start seeing is a number of funds, whether they be ETFs, whether they be global emerging market funds. You've seen it, just like we've seen in gold, we've seen a massive sell-off in a lot of these funds, okay, where they're now going back into more legitimate is the wrong word, but more not emerging markets, but developed markets. So that will help. Also, I'm very positive on the dollar this year. Okay, I mean, I do see the euro. It has to start heading towards the low 130s. Okay, because this will not help any kind of export, any kind of current account deficits, away from Germany. Okay, in the eurozone, 162-ish. It's got to be lower from a trade-weighted index balance, okay, with sterling. So therefore, the markets will have to move into, I expect in the dollars, okay. And if we start seeing, political turmoil continuing in Turkey, the Central African Republic, this continuing situation in Syria, in Turkey, in Indonesia, in Thailand, people just, they'd rather get. This goes back 3-ish years ago, right? When the Bundesbank auctioned a 2-year note at minus 0.27%, okay? It was 3 times oversubscribed. People didn't want a return on their money. They wanted their money returned, okay? And I think this could be a major situation where people look at the political stability of where they're going. I like Mexico. I like Colombia.
For holidays.
Oh, I love that place. But I mean, O'Brien now, or Jim McNeil from Goldman, who's now an independent consultant, has gone from the BRICS to the Mint. Now, Mint is Mexico, Indonesia, Nigeria, and Turkey. A couple of those kind of bother me. We've seen the real whack that the Indonesian rupee's taken. And so I think, with China, I mean, I think we're getting back to, everybody's downgrading China, but I think one of the things was in 2012 and even going into 2013, we really weren't worried about what was happening in the rest of the world because, hey, China will bail us out. Well, they may not. And if they don't, then I'd be worried about the New Zealand dollar. I'm far more positive on the New Zealand dollar than I am the Aussie dollar, as long as we don't have any more poison milk. Several areas, in Scandinavia, it'll be quite interesting to see if the Norwegian fund can rebalance their investments because gold and oil haven't been too well. And, you don't want to talk to anybody from the Swiss National Bank. You see, for the first time since 1907, the Swiss National Bank will not pay a dividend. So that's a slight problem with it. But I mean, it's going to be a very interesting year. But it's also going to be a year, and I'm not trying to be frivolous about it, But something that we talk about today, again, 130 tomorrow, right? Say if we do get 300,000 on-file payrolls, or what happens if we get 150, but tomorrow will be, I think, an extremely important data point, okay?
Yeah.
Will it justify what the Federal Reserve said, slowly data dependent? I would not, say if we get 300,000, I would not see the 10-year going to 3.5%. I mean, it may go up above the 3% level, but people are still that cautious. They're not selling all the bond markets, okay?
So it might kick a bit of volatility into an otherwise boring week.
Boring is,
Let's hope so.
Yeah, because I'm getting just concerned about my.
And to finish, what position would you want to have ahead of the number tomorrow?
Well, I'm still.
If you were just trading over the figure.
Yeah, I'm still dollar positive. Okay, so I would continue to be short the euro. I would probably be, again, a cautious short in sterling. I would have to say that I'm not as bullish about dollar yen. It got up to that 105.50 level. I would have to see it get back to like 103 before I got bullish again. I'm more positive on the New Zealand dollar than I am on the Aussie dollar, and I think I would look at Sweden as a better situation.
And on one of the indices, would you want to be short or long?
It's hard to say. I like a number of
US
stocks. I like here in the UK, I like the housing market. I like the related housing market. I mean, the automobile industry's done extremely well. I think we may see, just because it's been battered for so long, a technical bounce. One little stock that I've been following, African Barrack Gold, okay? I mean, all of a sudden that's up like 18% in the past 10 or 12 trading days, just for the simple fact it had been knocked down so much, okay? And I think other stocks, mining stocks, and oil-related or commodity-related stocks, you've got to look at the political situation.
China.
Yes. And so, you saw like iron ore is taking a big hit if growth starts to slow down. But it's one of those things where I don't know anything about technology. The banking stocks, I think, have done well. The thing we'll have to look at in reference to that is, buy to let scheme or the buy to whatever scheme and the funding, the loan funding scheme. It's all very nice to say we're seeing a bubble. But I mean, I think if you live in Rochdale or Runcorn, East Yorkshire or something like that, you get 2% appreciation, that's a bubble for them. Where 25% in Chelsea is sort of a meaningless number. But I think it's a situation where what you'll have to do, again, like in the last couple of years, up until maybe 2012, it was very easy. You bought mining stocks, and you just went home for 12 years. Now you have to, look at what's hot and what's not. I don't know anything about technology. I still have a, dial mobile telephone. I don't know what an iPad is, don't care. So, don't talk to me about that. I do like a number of stocks that have been hit down. Another stock that I've liked for 10 years is Topps Tiles.
Well, that's done well recently.
Yes, it has, okay. I was in that years ago. Now with the housing market coming back in, okay. Also, the fact is, I know people are recommending recruitment companies like Hayes, Walter Page, I think like that. These are, stocks that if we start looking to go from temps to perms, these are mid-market type stocks that will be positive.
Brilliant. Well, thank you very much, Bill.